Hello, my name's Charles Delastic. I'm the Managing Director of Blue Bond Tax Planning. We've been inheritance tax specialists for more than 18 years and have helped hundreds of clients save millions of pounds on their inheritance tax planning. So today's video is around how a partnership, and more specifically a limited liability partnership, can save income tax for a family almost immediately from when it's set up. Okay, so today's video is around the subject of how a partnership, and more specifically a limited liability partnership, can save income tax for a family almost from the day that it's set up. Now, owners of large property portfolios are often driven into high rate tax because of the Section 24 tax rules, or simply because the rental income from their property portfolios is quite large. Now, when properties are held personally, the income profits have to be distributed and all taxes paid within the year that they arise. In addition, if the property portfolio is owned by the married couple, legally, the distribution of the income should be in accordance with the ownership of the properties, and that's usually 50-50. However, sometimes that doesn't save tax. So once a partnership is set up between, say, a husband and wife, the income can be distributed in any way the partnership sees fit. So 99% of the income could go to one person and 1% could go to the other person. This can save income tax in circumstances where one person already has an alternative income coming in. For example, somebody's got a state pension or a final salary pension scheme paying out already and the other partner hasn't. And by changing the distribution of the income to the two partners, that will save income tax if it drops one partner below the 40% tax rate. Okay, so when within a partnership, the property income can be adjusted to make sure that neither person is driven into high rate tax. How else is it done? Now, if there are children that you have who are over 18, income can also be distributed to the children. So they can be partners for the income, but not for the ownership of the properties, because obviously if you transfer the properties to them, capital gains tax and stamp duty land tax will be payable. So, but income can be paid out to your adult children. Now, sometimes adult children are at university or they're working with very low incomes, and therefore distributing income to your children can save tax overall for the family, especially if you've got a non-tax paying child at university or something like that. Currently, they have an allowance of £12,500 of tax-free income that you could utilise. Therefore, utilising the various allowances and changing the way that the income is distributed once properties are held in a partnership can save significant income tax for the family overall. Okay, so hopefully you found that useful. If you did, please give the video a like. Thank you very much for listening, and bye for now. Bye.